Hi, welcome to Let's Talk Bonds, the fortnightly podcast from INR Bonds. I am Arjun Patsati, and in this podcast, we will talk about whether the corporate bond market is becoming more efficient. A lot of changes have happened to the corporate bond markets in India over the last 1 year, and especially over the last few months. And given these changes, it does seem as if all these changes are leading to more efficient corporate bond markets. And by efficiency, I mean that the credit risk of an issuer is being priced more correctly or better and better. And there are many factors contributing to this. One is that the most important factor I see is that the budget for the last year brought in uh, uh, to remove any kind of tax arbitrage on on debt funds. And given that there is no tax arbitrage available in any fixed income product at this point of time, then the market is forced to accept. Market will have to price each and every bond accordingly to the risk that it carries. No, normally, when there is tax arbitrage, we did see that there is a lot of risk that is which is mispriced because of the taxation issue that is clouding investors' mind. The other factor, apart from that taxation of debt funds, is also the fact that MLDs, market linked debentures, that were again a tax arbitrage product, have been completely uh, wiped out, and the taxation has been any kind of tax arbitrage is completely removed. So MLDs for the last couple of years were a huge attraction for high net worth and ultra high net worth investors, largely because they offered a tax arbitrage. And a lot of issuers with credit risk, uh, carrying credit risk of various degrees, were able to borrow at better levels than what they would have been able to borrow if there was no tax arbitrage. So clearly, there was a mispricing of credit risk. Fortunately, there's been no major uh, issues that has come through. But having said that, the cost of borrowing for credits for issuers who have been um, able to borrow at better levels of risk because of tax clouding is now being forced to access the market at what the market is demand in terms of pricing, especially in terms of how they perceive the credit to be. So, and the third is also the fact that corporate bond trading and investing for institutional investors, again, is also becoming electronic, with SEBI forcing them to go into the RFQ platform. And for retail investors, the price discovery is becoming very, very efficient with the arrival of bond platforms like INR bonds and many others. And SEBI has given recognition to all the platforms, giving them an OBPP license, that is online bond platform provider license, um, registrations, and what regulations, as in the SEBI does not give out the license, the exchanges give out the license, but SEBI has brought them under their regulatory banner. Now, again, which is much better for investors because there is a good amount of transparency in the process of investments in corporate bonds, which earlier wasn't there. And since the markets are completely online, there is much more ease of investment, more information available, and more importantly, more a better price discovery. So are not investors are not in the dark about what the price they are paying for the bonds they are investing in. And with the regulatory oversight, investors also have a redressal mechanism to actually, if they have any complaints against any of the platforms, they can always go to SEBI if they don't see the complaints addressed by the OBPP. Now, all this is very positive for the corporate bond market. But having said that, I must highlight that the risk of corporate bonds is always there for individual investors. Corporate bonds carry interest rate risk. That means prices can go up and down. Credit risk. That means there is a possibility of default if the financial stability of the issuer is falling. And a liquidity risk. That is, investor may not be able to sell the bonds given the nature of the bond or the market itself at that particular point of time. But investor should be aware of all this before investing in corporate bonds. And the best person to speak to is your financial advisor, who will highlight the best risk return profile of a bond. And if you're a financial advisor, the best place for you is INR Bonds Partners, where you can access the full information on corporate bonds to put it into your clients' portfolios. And given the transparency in pricing and the ease of investments through a completely online process with no risk, as all the settlements are done by the clearing corporation of BSE or NSE. And hence, your money is not transferred. The funds are directly transferred to the exchange, not the platform or the broker, which actually protects you, the investor, from any kind of counterparty risk. So all this put together is leading to more efficiency for corporate bonds. And financial advisors now, who are actually showcasing more bonds and giving better returns for their clients, are seeing their assets grow in fixed income. And this can lead to more and more growth in fixed income assets and more participation by a large section of investors who have been left out of the market, corporate bond market. And INR Bonds Quick Invest app is a good app for investors looking to invest in bonds with a curated list of bonds on offer. Most information, again, best of pricing, most transparency in pricing, and the easiest of in-app investment process with the complete support from INR Bonds. And INR Bonds is a SEBI registered platform and offering bonds for investments for investors. Now, coming back to whether corporate bonds are becoming more efficient, I do see that corporate bond market is becoming more efficient. Now, credits are priced accordingly, according to one is what is the outlook for interest rates, whether they're going up or down. The second is outlook for the credit itself, whether there could be any deterioration in balance sheets or improvement in balance sheets, and the liquidity and how liquid the bond is in the market. Now, there one space, one section of investors, again, like insurance companies and provident funds who invest in long-term bonds, they clearly have not they clearly look at what their own requirements of in terms of meeting their liabilities. Hence, if you see the term structure of rates or in yield curve, then you see 10-year long-term bonds are offering better or lower returns than short-term bonds. And the reason short-term bonds are priced higher is because the investor segment is more discerning, and they invest according to what the market conditions are and the issuer profile, rather than looking at their own long-term liabilities. Hence, short-term bonds are priced higher than long-term bonds, lower than long-term bonds. That is, yields are higher than yields on long-term bonds at present. And this is again a sign of efficiency of the market, as the investor segment that is dealing in short-term bonds are saying that are evaluating each and every bond according to its own merit rather than looking at any kind of a tax arbitrage or anything, any of that sort. Hence, all this put together is making pricing of bonds more attractive. So you have a clearly established yield curve at this point of time. So we have AAA corporate bonds in a 1 to 3 year range, trading at around 8 to 8.3, 8.5% levels. Then going down, you have 1 to 3 year bonds for AA, AA plus and AA bonds in a range of around 8.5, I could say 8.5 to even 10% kind of levels, depending on the issuer. And then going down to A and BBB, the rates range from 10% and above to even 13, 14%. And all this clearly establishes a good yield curve, a rating curve. Earlier, because of this tax advantage of tax arbitrage of MLDs and also tax arbitrage on debt funds, we found a lot of bonds were priced much higher in terms of prices, or much lower in terms of yields, where clearly tax was playing a large part in pricing and not the merits of the market and the issuer. Now, the merits of the market and the issuer are coming to the fore. And this is a very good scenario for investors, because they know that they are buying a bond at the right price after deep evaluation by either the investor or the financial advisor, and definitely by the market itself, which determines the price of the bond. Hence, investors and financial advisors can definitely look at the bond market with a much better light, and given the efficiency factor. And this kind of efficiency is very positive for the development of the corporate bond. And platforms like INR Bonds is focused on improving the development of the market through better price discovery and more information. Thank you very much for listening in, and do follow us on all podcast apps, including YouTube, Spotify, Amazon, and Apple Podcasts.